Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Victoria's Secret & Co. annual report. Victoria's Secret & Co. offers a wide range of products and services to its customers worldwide. At the core of their business are intimate apparel items such as bras and panties, which come under various brands including Victoria's Secret, PINK, and Adore Me. In addition to lingerie, the company also provides casual sleepwear, loungewear, sportswear, and swim products for women. Their product line is not limited to clothing alone. They also offer prestige fragrances and body care products that cater to customers' beauty needs. Victoria's Secret & Co. has expanded its services beyond retail stores by providing online shopping options through their websites, including victoriassecret.com, pink.com, adoreme.com, and dailylook.com. They also operate through other digital channels, making it convenient for customers to shop from anywhere in the world. The company operates under various business arrangements, including franchise, license, and wholesale agreements, which enable them to reach a broader customer base. By offering a diverse range of products and services, Victoria's Secret & Co. has established itself as a leading specialty retailer in the women's intimate apparel and beauty industry. Victoria's Secret & Co. market capitalization of $4 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Victoria's Secret & Co. holds a significant advantage in their industry. Victoria's Secret & Co. trades at a higher price-to-earnings ratio of 23 times and a higher price-to-book ratio of 5.5 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 85% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, the company's market-leading brands, global scale and reach, agile supply chain, and investments in store refreshes and omnichannel selling have contributed to its success. Additionally, product innovation, brand equity, customer experience, and successful implementation of strategic growth plans have also driven revenue growth. On the decline side, increased net tariff costs, inventory reserves, and severance expenses resulting from restructuring operations have negatively impacted revenue. Decrease in business performance, estimated future cash flows, discount rates, and market rental rates have also contributed to revenue decline. Other factors that influence revenue include sales volume, seasonal sales patterns, success of new product introductions, profit margins, income taxes, inventory valuation adjustments, and physical inventory loss adjustments. These drivers highlight the complexities involved in managing a global business with multiple revenue streams. The net income of a company underwent significant changes between 2024 and 2025. Initially, it was reported that the net income decreased by approximately $99 million in 2025 due to tariffs and a security incident. However, further analysis revealed that this decrease was not as drastic as initially thought, with the net income actually increasing by $20 million compared to 2024. Despite this increase, other factors such as a 10% rise in inventory valuation adjustment and estimated physical inventory loss adjustment led to a decrease of approximately $6 million. The profit margins also experienced changes during this period. The gross profit rate decreased from 36.7% to 36.4%, while the operating income rate dropped from 5% to 4.1%. These decreases were attributed to various factors, including impairment charges of $19 million recorded in the fourth quarter of 2024. The conflicting statements throughout the summaries highlight the complexity of analyzing financial data. However, based on the clearest information provided, it can be inferred that net income decreased by approximately $99 million in 2025 due to tariffs and a security incident, while profit margins experienced decreases across both gross profit rate and operating income rate. The company's financial performance has shown a significant improvement in recent years, as evident from its ability to generate substantial amounts of positive operating cash flow. According to the latest available data, the company generated $499 million in positive operating cash flow in 2025. This trend is consistent across multiple pages of the report, with confirmations on pages 41, 62, and 76 further solidifying this conclusion. The generation of positive operating cash flow is a crucial indicator of a company's financial health, as it signifies that the business is capable of covering its operational expenses without relying on external funding. This achievement demonstrates the company's ability to manage its resources efficiently and effectively, ultimately contributing to its overall success. The company's performance varied across different segments and regions. In terms of poor performance, the China joint venture segment struggled, with a decrease from 30 stores in 2025 to 20 stores in 2026. International markets also underperformed due to associated risks. On the other hand, some regions showed no significant change or unclear performance. The US and Canada segments maintained the same number of stores between 2025 and 2026, with 24 stores in both years. Management is optimistic about the company's future prospects, citing a leading market share, loyal customers, and an engaged brand community. The growth plan, Path to Potential, aims to accelerate growth by differentiating brands and reinforcing authority in North America and internationally. The plan focuses on 4 key priorities: supercharging bra authority, recommitting to pink, fueling growth in beauty, and evolving the brand projection and go-to-market strategy. To achieve this, management plans to invest in fleet by refreshing existing stores with a store of the future concept, optimizing physical retail footprint, and enabling seamless omnichannel selling. Management is also prioritizing cost management while continuing to invest in product innovation, brand strength, and customer experience. The company expects capital expenditures to be in the range of $220–240 million in 2026, focused on investing in store capital program and customer experience, as well as technology and logistics to support strategic initiatives for growth and operating efficiencies. Overall, management is confident in the company's ability to drive growth and improve profitability through its Path to Potential strategy. The company has made significant moves through acquisitions and divestitures. 2 notable acquisitions include the purchase of Adore Me, which also encompasses Daily Look, as mentioned on page 30 and further detailed on page 88. This strategic move aims to expand the company's offerings and reach. On the other hand, the company has opted for a more streamlined approach through divestitures. One such instance is the joint venture with Next plc in the United Kingdom and Ireland. As a result of this partnership, the company no longer operates stores in these countries, marking a strategic shift towards focusing on other markets. The company's financial activities have been focused on share buybacks rather than dividend payments. According to the provided information, the company has indeed engaged in buying back its own shares, as stated on page 42 of a relevant document. This indicates that the company is choosing to reinvest its profits into itself by reducing the number of outstanding shares. In contrast, there is no mention of the company paying dividends to its shareholders. Concerns about inventory buildup and supply chain disruption are evident throughout the document. Inventory buildup is a recurring concern, with potential consequences including reduced consumer demand, production or shipping delays, and increased pressure on fulfillment network capacity, leading to stockouts. The company's practice of accumulating significant amounts of inventory before the holiday season selling period also raises concerns about inventory buildup. Supply chain disruptions are another major concern, with potential risks including difficulties with distribution facilities, supply chain challenges causing higher costs and longer lead times, and disruptions to order taking and fulfillment operations. Geopolitical instability, labor shortages, high interest rates, foreign currency exchange volatility, tariffs, and natural disasters also pose significant threats to the company's supply chain. The impact of these concerns is evident in the financial implications, with a 10% increase in inventory valuation adjustment potentially impacting net income by approximately $6 million for 2025. The need for working capital peaks during the summer and fall months as inventory builds in anticipation of the holiday season, further highlighting the importance of managing inventory levels effectively. Overall, addressing these concerns is crucial to ensuring the company's continued success and mitigating potential risks associated with inventory buildup and supply chain disruption. That concludes the financial summary for Victoria's Secret & Co. Feel free to comment below, and I will be happy to answer them when possible.